Academic finance relies on elegant mathematical models that assume human beings behave with perfect rationality. Then reality hits. The dot-com bubble bursts. Lehman Brothers collapses. The smooth curves of financial theory are violently replaced by sheer, chaotic panic. The origin of that elegant math is the Chicago School of Economics and its foundational efficient market hypothesis. This theory argues that market prices instantly and perfectly reflect all known available information. If every asset is priced with perfect precision, finding a bargain is mathematically impossible. Generating alpha, returns that beat the market average, cannot be done through skill, only by taking on excessive risk. To see the flaw in this absolute thinking, consider the classic joke about the finance professor walking with a student. The student spots a $10 bill on the ground and reaches for it. The professor stops him, saying, "Don't bother." If it were a real $10 bill, someone would have already picked it up. The professor's logic works beautifully on a chalkboard, but in empirical, real-world markets, $10 bills are dropped all the time. Markets are not driven by rational algorithms. They are driven by flawed, emotional human beings who frequently misprice assets to an astonishing degree. If the academic consensus is flawed in practice, outperformance is possible. You just need a rigorous, systematic framework designed specifically to exploit those human errors for asymmetric returns. Few investors have exploited those errors as successfully as Howard Marks. Over 4 decades of booms, busts, and bear markets, Marks built a track record that commands the attention of the entire financial world. Marks observed a crucial distinction. He agrees that markets are highly efficient at processing information quickly. Where the market fails is in pricing that information accurately. This inaccuracy is entirely the result of human psychology. Investors act as a herd, reacting emotionally to headlines and swinging from euphoric greed to paralyzing fear, completely distorting asset values in the process. To survive and profit from this chaos, Marks published his philosophy. He didn't offer a single magic formula. Instead, he constructed a comprehensive architecture of 21 distinct philosophical principles. Mastering these interconnected principles is the only repeatable method for escaping the median. It is how an investor achieves superior risk-adjusted returns without relying on luck. The vast majority of market participants rely on surface-level reactionary observation. They see a company with surging profits and a great product, and they decide to buy the stock. Marks calls this first-level thinking. The mathematical trap here is inescapable. If everyone already knows the company is great, the stock price has already been bid up to reflect that greatness. If your logic matches the consensus, your returns are guaranteed to be, at best, strictly average. Escaping the average requires second-level thinking. This is a probabilistic, variance-seeking logic. It asks harder questions. What is the crowd thinking? What has the market already priced in? And how is my view different? We can map the requirement for alpha, excess return, on a simple matrix evaluating your behavior and your judgment. If your behavior is conventional, even if your judgment is highly accurate, you simply match the market. Conversely, if you hold unconventional views that turn out to be wrong, the market will punish you with disastrous losses. There is only one path to outperformance. You must be entirely non-consensus in your behavior, and you must be empirically correct in your judgment. Outperformance is not a birthright. It requires the painful, complex analytical work of uncovering micro-details that the rest of the crowd completely misses. This chart shows the absolute, objective yardstick of an asset's worth, its intrinsic value. This flat line is grounded in discounted cash flows, hard assets, and underlying earnings. It is stable and measurable. But we do not buy assets at their intrinsic value. We buy them at the market price, which fluctuates wildly as the crowd's emotional state swings back and forth across that stable baseline. When the market price dips significantly below the intrinsic value line, it creates a crucial delta. This is your margin of safety. Buying in this zone provides a high probability of profit and deep protection against error. Conversely, when euphoria takes over, the market price skyrockets above intrinsic value. This delta is the zone of extreme risk, where investors pay exorbitant premiums for popular assets. Wall Street learned this the hard way in the late 1960s with the Nifty 50 stocks. The consensus firmly believed companies like IBM and Xerox were absolutely invincible. Investors adopted a buy-at-any-price mentality for these pristine companies. But price always matters. When the market inevitably corrected, those holding the Nifty 50 suffered decades of destroyed capital just trying to break even. There is no such thing as a good or bad asset independent of its price. Overpaying for a phenomenal company is a guaranteed method of losing money. This chart shows modern portfolio theory's definition of risk, beta, or the standard deviation of an asset's price. Academics view these high-frequency, temporary fluctuations as danger. Marx completely rejects this. True risk is not temporary volatility. It is the absolute probability of permanent capital loss. It is the chance that you invest your money and it never comes back. This presents a major paradox. True risk is entirely invisible, and it actually reaches its maximum exactly when the macroeconomic environment feels the safest. Good times teach bad lessons. Prolonged periods of optimism breed arrogance, convincing investors that the old rules no longer apply. This comfort strips away the risk premiums that usually protect capital. This psychological arrogance manifests mechanically. Desperate to deploy capital, investors willingly accept lower returns for higher risks. Lenders throw out basic protections, issuing covenant-light loans that create a highly fragile financial architecture. Risk cannot be eliminated by ignoring it during a bull market. The failure to imagine the worst-case scenario is the exact precursor to systemic collapse. In financial markets, there are two absolute certainties. First, trees do not grow to the sky. Everything is cyclical. Economies expand and contract. The second certainty is that the greatest financial losses in history occur exclusively when the crowd forgets the first certainty, convincing themselves that the cycle has been permanently tamed. These cycles are driven by a continuous psychological pendulum. It never rests at a rational midpoint. Instead, it swings relentlessly from absolute risk aversion, fear, to absolute risk tolerance, greed. This psychological pendulum directly controls the mechanical credit cycle. Human emotion dictates the flow of global capital.
When the pendulum reaches greed, credit becomes exceptionally cheap and easy to obtain. Lax lending standards immediately lead to systemic overexpansion. Companies take on excessive debt, pushing the economy to a tipping point that inevitably triggers widespread defaults. Those defaults act as a catalyst. Panic sets in, and the pendulum swings violently back to fear. Lenders shut their doors, resulting in a severe credit crunch that starves even healthy businesses of the capital they need to survive. At the extremes of this cycle, rationality vanishes entirely. In a bubble, the crowd's only fear is missing out. In a crash, their only fear is losing more money. Breaking free from this cycle requires contrarianism. But true contrarianism is not just reflexively doing the exact opposite of the crowd. It requires maintaining deeply researched, independent conviction.
To do this, you must develop symmetric skepticism, the mental discipline required to push back equally against two opposite extremes. The first extreme is pushing back against overwhelming, irrational optimism. When traders are euphoric and throwing money at unprofitable ideas, you must step back and logically deduce that the situation is too good to be true. But the second extreme is much harder. You must push back against absolute paralyzing panic when every headline is screaming about an impending systemic collapse. In October of 2008, amid the collapse of Lehman Brothers and AIG, the consensus view was sheer Armageddon. True contrarians had to stand entirely alone in that firestorm and logically conclude that the extreme pessimism was actually too bad to be true. Catching falling knives based on intrinsic value is psychologically grueling. It guarantees long periods of looking foolish, acting against your own survival instincts, and enduring intense discomfort. If an investment feels perfectly comfortable and receives total approval from your peers, it is mathematically incapable of generating superior returns. Profit is born from discomfort. This leads to the active manager's greatest trap. Driven by bias and ego, investors feel a constant nagging urge to trade, tweak, and act just to justify their own existence. Charles Ellis described this dynamic perfectly with his tennis analogy. Professional tennis is a winner's game, decided by spectacular, unreturnable shots. But amateur tennis is a loser's game. The victor is the player who methodically returns the ball over the net until their opponent makes an unforced error. For almost all investors, the financial market is a loser's game. Long-term success does not come from executing brilliant market timing. It comes from drastically minimizing your own unforced analytical errors. The solution is patient opportunism. The market does not penalize you for standing at the plate with the bat on your shoulder. You are allowed to wait indefinitely without swinging. This strategy has a strict operational requirement: the deliberate accumulation and protection of cash during a boom. Holding cash is frequently criticized as a drag on performance, but cash is highly valuable, unpriced optionality. When the credit cycle eventually crashes, cash is the only weapon that allows you to buy assets at deeply depressed valuations. The greatest threat to compounding your capital is reaching for yield out of sheer boredom. True professionals simply wait for the cycle to serve a fat pitch right down the middle. To know when that pitch is coming, you have to abandon macroeconomic forecasting. Predicting the exact timing, extent, or specific trigger of a cycle's turn is an exercise in total futility. We cannot ever know where the market is going, but it is our absolute duty to know exactly where we are right now. This requires the skill of inference. You must stop trying to gaze into a crystal ball to predict future data, and instead take the market's current temperature by analyzing observable behaviors. Consider the observable environment of 2007. The market was flooded with record levels of risky debt. Lenders were actively eliminating loan covenants, and private equity firms were engaged in reckless bidding wars. These were hard facts. Read correctly, they screamed that the market was dangerously overvalued and starved of risk aversion. It required absolutely zero psychic ability to prepare your portfolio for a severe downturn. The thoughtful investor abandons the arrogance of trying to predict an unknowable future, choosing instead to be a meticulous detective of the observable present. There is one final illusion to dismantle: the assumption that a highly profitable outcome is proof of a brilliant initial decision. Nassim Nicholas Taleb introduced the concept of alternative histories. The world operates as a vast probability distribution, yet we only get to observe one random outcome play out in reality. This chart shows how easily we confuse the illusion of certainty with the reality of probability. We routinely label outcomes driven by luck and coincidence as the result of skill and causality. This creates massive survivorship bias. If you put 10,000 monkeys in a room to flip coins, one of them will statistically flip heads 10 times in a row. The crowd will hail that monkey as a genius, despite zero underlying skill. You cannot evaluate a portfolio manager purely by their past returns. A massive gain achieved through unhedged leverage during a raging bull market is not evidence of talent, it is the fingerprint of a lucky idiot. True investing skill is not the ability to maximize returns in the one specific scenario that happened to play out. Skill is the ability to structure a portfolio that survives a wide distribution of unseen, highly negative probabilities. Investors cannot control the macroeconomic cycle. They cannot rein in the irrationality of the herd, and they certainly cannot predict the future. Because of these limitations, the crowning objective of the thoughtful investor is the creation of an asymmetric return profile. It begins with a bedrock foundation of intrinsic value. That foundation is built upon layer by layer. You apply second-level thinking to escape the consensus, utilize cycle inference to gauge the current environment, and maintain symmetric skepticism to resist the emotional pull of the extremes. This chart shows the mathematical definition of asymmetry, capturing a high percentage of the market's upside during propitious environments while suffering only a tiny fraction of the downside during hostile ones. As Warren Buffett has long maintained, investing is fundamentally an act of defense. It is the strict refusal to strike out while waiting patiently for the fat pitch. The ultimate goal of investing is not to squeeze out every last drop of potential return, or to chase the ego-driven accolades of Wall Street. The goal is compounding your capital, surviving the inevitable crash of the pendulum, and quietly winning by simply refusing to lose.